Hello everyone, guys, and welcome to our webinar. Thank you for joining us today. So today we have got a fantastic group of speakers lined up to discuss the latest macro trends and dive into the world of layer 2 networks and applications. Before jumping into the discussion, I would like to introduce Eric, our amazing founding partner. So Eric, the stage is yours.
Oh, thank you. It's a great pleasure to be here. So I'm representing BIMAR and our venture side, Cipholio. So it's a great pleasure. And like always, BIMAR Exchange has been in the market for over 5 years. And last couple of weeks are our 5th anniversary. And also we are giving back to the community and by investing in the ecosystem and helping the entrepreneurs to build up their own startups. And it's a great pleasure to partner with Paul from Quintegra Accelerator Program and to really help the startups from the scratch and to exceed and success. So next slide, please. So we're also having a very interesting program for the learning module. And today we also have some very fantastic students from Global and to join this webinar and to learn what is the Web3 and what's opportunities here. And last but not least, we are more than happy to share the deal flow and also to learn what's the amazing startups and global events. So we will also having some events in Hong Kong during the April for Web3 Festival. And also during the consensus, we will have an after party. So if you are there, and please DM me and we can have some drinks together and to share the insights of the world. So thank you so much.
Thank you, Eric. Thank you, Eric, for your introduction. So let's now kick off with the first part of our webinar, which lasts for around 15 to 20 minutes. In this segment, we have Jessica from Three Rings Capital to give us the lowdown on the latest trends in the macro crypto market. Let's give a warm welcome to Jessica. Jessica, can you hear us?
Yeah.
Hi, Jessica.
Me?
Yeah, sure.
Yeah, I will share my screen. Hi, everyone. Thanks for having me here. So my name is Jessica. I'm the founder and the CEO of Three Rings Capital. Three Rings Capital, I actively manage the Web3 hedge fund, investing mainly in cryptocurrencies. Our team, including myself, has experience in both equity trading and crypto investing. So our approach combines the macro and fundamental research, aiming to capture both alpha and beta opportunities throughout multiple market cycles. So last year, things fast started to hike interest rates. The macro has been driving most of the market. So today I will share a bit of our macro insights. So we built a macro framework based on how we understand the crypto market impacted by the macro. So people talk a lot about like the inflation last year, talk about like, the interest rate. So based on our understanding, simply put, the macroeconomics, three major elements: economic growth, inflation, and unemployment will impact the monetary policy, meaning reflected on interest rates, balance sheet, and money supply, and it will impact the market liquidity. And then the market liquidity situation will impact the prices of different asset classes. So in our view, the crypto macro market level actually have two major factors. The first one is availability and the cost of money and credit. That is impacted directly by the market liquidity. And the second factor is asset narrative, the risk premium. So things crypto is a relatively new asset class. So for most of the time, the market has priced crypto correlating with equity, particularly growth equity. For the very short term, we've seen a divergence. But for the base case, we still think the crypto asset class will be correlated with equity, particularly growth equity. So things crypto assets don't rely on earnings, just like as traditional equity. So the liquidity would impact the market in a very direct way. So today I'll talk about like the liquidity, how we think about the current liquidity and the future trends of the market liquidity. So before that, I'll touch upon a bit about the recent banking problems. So the recent events in the U.S. regional banking sector have raised concerns on the availability of credit to businesses and also impacts on real economy. So based on our study and analysis, we've seen that the U.S. small banks problems have arisen from the imbalances between assets and liabilities as a result of the hiking interest rates. But it's actually a management problem, not a systematic risk, as over 50% of the small banks' assets are actually fixed rate mortgage-backed securities. Usually, the duration is over 10 years. So there's a very high duration risk. Meanwhile, we've seen that decreasing assets of U.S. commercial banks as a result of the slowing monetary supply growth and also the increasing outflow from the small banks. So I think the problems could only be solved if the Fed cut rates. Otherwise, the imbalance between assets and the liability will continue, and that may lead to the market liquidity risk. I mean, people talk about like, whether it will be the same as like 2008, the great financial crisis. But in our view, it may not be as bad as it was in 2008. Since the regional banks' assets accounts only for like 1/3 of the total commercial banks' assets in the U.S. and 10/3 of the total U.S. assets. And also the assets quality is much better than it was in 2008. Most of the asset MBS, though it has duration risk, but still the credit risk is very low. And also the household private balance sheet remains healthy. So it may not be as bad as the great financial crisis. And also the impact on the real economy may be not as high as it was in 2008. But still, we think it's worth watching out the tail risk. For instance, the lending standards actually has been raised and tightened for small businesses. So for the small businesses, they may face like very tough challenges getting the loans. And also it takes months before the ramifications of worsening lending standards fully played out. And also, I think the Federal Reserve will also, be watching out the actual impacts on the real economy. But within this period, I think so far it may now lead to a credit crunch based on the current situation. So that's just my 2 cents for the recent banking problems. And then we'll jump to the liquidity. So what the market thinks for now, the market actually expects the Fed to provide liquidity support and the cut interest rates. The market actually expects like near 100 BP of cuts in this year. So recently we've seen a rally in the Bitcoin and also gold and the growth equity. So that all due to the expectation of rate cuts. So actually Bitcoin's correlation with US equity changed on March 13th. That's the same day when the rate equity correlation flipped. So from the chart, we can see the market has priced in a lot of rate cuts. So the assets that doesn't rely on earnings would benefit. And also from our liquidity structure, from the macro level, mid level, and the micro level, we've seen that recent banking problems has increased, actually has like led to the tightening of the liquidity. This is just an example of the liquidity indicator. It mirrors how the markets think about the credit conditions, and also the higher ratings typically reflects rising interbank lending risk. Basically, things like, several weeks ago, the regional banking crisis had led to the tightening of the credit conditions, but now things have eased. So I think it's an important indicator to monitor. So if the spread continue to decline, we may see the recent rally continuing. But if the spread reverse to rise, actually, I think the market will suffer from the liquidity risk again. As I mentioned, I think the regional banking problems are not over, and there's still a risk in the market liquidity. So the liquidity indicator is a good way to start. And also things like, current for the very temporary term, the spread has eased. So that's why we see the recent rally in the crypto market and also in the growth equity market. What about midterm? Although the markets expect the Fed to cut rates really soon, from like the history, we've seen that the Fed would not pivot until the liquidity spread has reached a very high level, either due to the credit event or recession. These two charts are just like, the high yield liquidity spread relationship between like the liquidity and equity and the Bitcoin. So the yellow line represents a high yield liquidity spread. It typically reflects the liquidity situation for risk assets. So we've seen a very clear reverse relationship between the liquidity spread and equity and Bitcoin. And only when the liquidity spread has reached a very high level, when the liquidity situation is very severe and the Fed would pivot and provide enough liquidity support, then the market will reverse and see a real turning point. So we expect this to happen late this year. That is later than the market expected. So we expect a further downside before we see a real turning point. Because as for now, the liquidity spread is not high enough. There is still much room to rise. So these indicators, I think we will continue to monitor, and also for the whole market situations, we think it's not yet bottoming out. So even after the Fed pivot, the market could still face liquidity crunch without sufficient liquidity injection from Fed. So when is a good time to do the deep buying? There are several aspects to monitor from our view. The first is the liquidity spread I just talked about. So when the liquidity spread has peaked, we see the clear peak, and that'll be a safer time to do the deep buying. And also, since our current basis is still that crypto will correlate with the equity market. So from the macro level, we'll also monitor the equity valuation and the market volatilities. We use the indicator VIX to gauge the market liquidity situations. So we think the market still has further downside, and it's better to monitor the liquidity situations and wait for the liquidity spread has reached a high level to do the deep buying. That's just like, some of the our insights from the macro level. So from the micro level of the crypto, we've also done a lot of study, but due to the time limit, I will not share about that today, but happy to talk about that further. So there are more like crypto related macro topics. If anyone is interested, happy to talk further and connect. Thank you for listening, and thanks for having me again. So feel free to just let me know if you have any questions.
Thank you, Jessica. Thank you for your insightful presentation on macro crypto trends today.
Thank you.
Let's now move on to the second part of our webinar, which is a panel discussion on the investment thesis for growing L2 networks and apps adoption. So this section will last for 40 minutes. Eric Bai from Cipholio Ventures and Paul Salstem from Cointelegraph will be our moderators for today. Please welcome our amazing panelists. We have Julian from Brockraise, Paul from D-Lab, Gilan from Mulana Capital, Nikhil from Struck Crypto, Glenn from Arcane, Rico from Signum, and Mohammed from Blockchain Founders Fund. Eric, you can start the moderation, please.
Thank you, Alicia. So as we can see, the current the hot topics after the L jobs of Arbitrum, there are a lot of attention coming to the stage, center of the stage of what's the layer 2 competition. And so therefore, it would be a very interesting topic to understand what is the investment thesis, if there is still has the opportunities on the layer 2, what will be and what kind of the applications will be on the layer 2 and what is the opportunities there. And for this panel, we will have 5 questions, and together with Paul and me and with the moderator. And so let's start from the first conversation about what's the key factors of driving the growth of the layer 2. And what is the layer 2 network and app adoption, and how to contribute each panelist your investment thesis. And so any volunteer for this question?
I'm happy to take the first shot at that. So we're seeing that, fees on Ethereum has been high for quite some time because a lot of dApps, specifically DeFi and NFTs, the network has processed over $7.7 trillion in 2021, which beats out the value processed by MasterCard in 2020, which was 4.7 trillion, PayPal's 1.3 trillion in 2021. Visa was at around 8.9 trillion in 2020. So Ethereum is getting quite competitive, and there's a lot of competition for the block space. This has led to, previously users moving to other chains like Binance Smart Chain, Solana, Avalanche, but it's also been shifting to L2s on Ethereum, such as Polygon, Arbitrum, and Optimism. So specific L2 chains are being favored for specific use cases, such as Polygon for gaming and Arbitrum for DeFi. This enables the users' needs to be met in the same ecosystem and prevents a lot of crosstalk compared to if dApps were interspersed across different chains. So when we evaluate investments, we look for projects that want to be multi-chain and have a core technical innovation. This should allow them to gain market share on whichever chain they choose to start off with. This ensures that projects can evolve with a growing landscape of L2s, that they're not confined to any one specific ecosystem, and gives them a lot of flexibility to grow their own ecosystem.
Yeah, thank you. I like your input. Yeah, so as we can see in the market as well, so there for layer 1 or layer 2, that they have the specific resources in each sector, and they can attract more chain specific projects and to build on that. So but another perspective, maybe that if anyone would like to jump in, is what I see is not sure other panelists will anchor this view or not. So a lot of what we see, the layer 2 developments were actually mirrored or duplicate what has been developed on the layer 1. So what we can see is a lot of projects they previously built on, let's say BSC, they are just build a new project and to build on the layer 2. So for them, they are just switching to tier, switching to different layer 1 and layer 2s, and without stickiness. So it's a very interesting perspective that what I observe in the market. So not sure whether other panelists have same view of that. But what we can see is for the layer 1, previously there were a lot of DeFi projects as the first infrastructure, and which will happen on the Arbitrum as well. As we can see, Grill, and they are one of the leading desks on Arbitrum, and their IDO process is very high. And then for layer 1, they will also have infrastructure like the IDO platform. It's currently what's happening on the layer 2 ecosystem as well. And then it goes to the other applications like gaming or X2N, and which will be on Arbitrum as well. So what we can see is a lot of previous experience on the layer 1, they will happen just as it is on the layer 2 ecosystem.
Yeah, maybe I can chip in on this. I definitely do agree with Nikhil, what Nikhil said. As VCs, you also don't want to invest in projects that have almost to zero innovation, whereby they're just a copy paste onto a new chain or a new ecosystem. And we do look for innovations either in the tokenomic sense or the product sense to invest. So for example, GMX, right, is always a good example for Arbitrum. GMX sort of revolutionized the whole P2P kind of PvP kind of experience between your liquidity providers and your traders, right? So you are betting. So if you are a liquidity provider, you are betting against the traders who are trading on GMX and so forth, or vice versa on the other side. So those areas where this kind of new mechanisms, or through tokenomics or the protocol design, really attracts VCs like us to look deeper into how that kind of mechanism works, and if there are any, and push the boundaries and try to stress test it. So those are things that definitely interest us over at Arcane, and we find that those protocols, you always have one winning protocol in every layer itself. So for Arbitrum, I would say that GMX is the one that sort of brought the crowd in onto that layer 2, and whereby guys like Camelot and Zyber, all these guys just piled onto it because of the sort of airdrop incentive that everyone's floating around. That's how they sort of brought the crowd up. But GMX was, I would say, the OG one that brought the whole adoption on Arbitrum and create the hype in the first place. And that's what we're looking for in other layer 2s.
Right. I totally agree with Glenn and also Nikhil's point. These emerging ecosystems, it's becoming easier and easier to spin up a roll-up. And what's also important is to have a good developer ecosystem so that it can also facilitate, building of some other novel use cases. Because, with the rise of ZK rollups, a lot of identity-related applications have been built, especially when it comes to KYC. And now it's starting to get a bit old. We're yet to see a few emerging innovations when it comes to using ZKPs or ZK rollups at that point. And with that said, even when it comes to app chains, it is moving towards a more modular future, I'd say, where you can use a different sequencer, maybe an ME-way resistant sequencer for your app chain or for your rollup, and execute it across different blockchains while using, let's say, an execution layer from Fuel or Succinct Labs.
Yeah, thank you, Mohammed. Yeah. So Paul, would you like to continue the conversation, or you have any thoughts to share with the panelists?
I think since we have started talking about the particular applications and what can be done practically in the new L2 ecosystem, I think it would be good to discuss and to ask the panelists what particular use cases, what particular apps they would be looking for in the development of the new L2s, because some of the things that those L2s are claiming and promising seem to be quite revolutionary, because all those EVMs, ZK EVMs and the ZK rollups saying that they plan to have pretty much gasless transactions and unlimited scaling. So, and when you hear those kind of claims and suggestions, you're thinking, well, there must be something interesting going on in the app space. Maybe there's something going to happen similar to what happened in the DeFi summer or with NFT in 2021. So it would be good to know if there anything we should be looking at currently, not to miss this kind of a sweet spot in 2023. What are your thoughts, guys?
Maybe I can start on this one. I think in general, as was mentioned before by the other panelists, these layer 2 networks really bring another 10x factor of scale, which we didn't have on layer 1, and then potentially with other upgrades that will come, there will be another 10x factors coming. And I think this scaling increase really enables new use cases where we need a lot of transactions, which where certain kind of models don't work on layer 1 because of these transaction costs. And one example here that I would highlight is exchanges, decentralized exchanges, where in the very beginning, actually on Ethereum layer 1, decentralized exchanges try to build it the same way as centralized exchanges, so with an order book. But very soon, we realized that this is not viable. Costs are much too high, because for placing an order, canceling an order, you have to make a transaction on chain, right? And so that's how we saw the emergence of this new concept of AMMs, which have been kind of dominating the space ever since. But that doesn't mean that from a purely concept and design perspective that an order book based exchange doesn't make sense. It does have a lot of benefits over the AMM model. And so with this increase in scale, we can actually go back and build decentralized exchanges that are built on, that are using the order book model. And we're seeing a lot of projects doing that, especially on upcoming CK rollups like CK Sync. And I think that's going to be very interesting because that's not possible to do on Ethereum layer 1.
And obviously there's other use cases as well, such as gaming, which has been highlighted before, which is very popular on Polygon. Any kind of low value transactions that become possible through that, basically.
Good. That makes perfect sense. Anyone else?
Yeah, adding to that, I think, fundamentally L1 chains need to have a token to prevent spam on the network. And that applies in some sense to L2 networks as well. The difference being that you kind of have a smaller subset of what's going to the L1 being sort of put on the L2, which then gets batched to the L1. So you definitely get a lot of scale from there. As for gasless transactions, I don't know if it would eventually kind of end up being gasless in the sense of being completely free. It might be extremely low cost. When you take a look at Arbitrum, for example, you can actually launch an L3 on Arbitrum with Nitro. They give you the code and they sort of encourage you in their docs to launch an L3 as well. So, there's no saying as to, okay, eventually in like the next 5 years, we might have L3s, L4s. And with each additional layer that you can have cheaper and cheaper transactions, which means you can have more complex pooling and capabilities on those chains, which you can't have on the higher level chain because it's just more expensive because the competition for that block space is a lot more. So that's kind of like, interesting because you're going to see all these different business models and you're going to see a lot more like variability in the feature sets that people choose to have on chain. But as you sort of launch your applications on, I guess, L2, L3, you need to depend more and more on the security of the previous chain. So you need to wait for everything to be rolled up to the eventual L1. So that's something that you do also have to consider when you launch an app on an L2, for example.
It's a very interesting perspective. Looking at the infrastructure, the cost of infrastructure, when we're also taking this maybe to traditional finance, back to traditional finance, I think you even mentioned PayPal and some of the payment processes that we use on our daily basis when we go shopping for groceries. They all have transaction fees, right? They're just carried by a merchant, and I think that is in part due to the infrastructure that they have to cover. And I think implicitly this also applies to any sort of blockchain, whether it's a layer 1 or layer 2. There has to be a sort of real world cost associated in order for it to be financially viable on all layers of the, let's call it the blockchain value chain, from the node operators to the people like verifying transactions and users on the blockchain. So having that in mind, right? Having something go cheaper and cheaper is a natural progression as we move forward and technology goes and improves, right? We see it with, I like to make that example of SD cards, right? In the early 90s, it was very expensive to buy an SD card, or late 90s, sorry. And today you can practically pick them up for almost, pennies on the dollar. And it really goes to show that progression as we move to that sort of environment is going to be part of that evolution of where we're heading as an industry. So when we're having layer 2s, right, and just from an investment perspective, right, and just looking at it from a venture capitalist perspective, in essence, right, you do, or as an investor, you would like congestion, right? It is actually in your nature to have congestion pushing up price, having demand for a certain token. The reason why people are so happy with early Ethereum investments is because there is a massive demand not only on the transaction side, but also just a demand from projects needing it to just have their token, apply the use cases, and so forth. So, but this in itself is a contradiction on where we want to take this industry, right? So on one side you have the venture capitalists, which includes me, and on the other side you have perhaps the people that want, or the innovators and developers that want to optimize and optimize and optimize. So the thing is, where do you strike that balance, right? And with that balance, you will always, as you progress, have competition. And I think that is also, how should I say, like a very important aspect to consider when we're looking at, value investing or investing over a longer period when it comes to this sort of innovation. And that's, I think, why layer 2s are a pivotal point for investment, because not only can you capture everything that's going on the layer 1, but also layer 2. So it just amplifies and multiplies the inherent potential that you see within the blockchain space when making an investment.
I would like to chime in here in support of Julian. Indeed, often when we talk about layer 2 with people, we tend to use an imperfect analogy where if we consider layer 1 as all different nations, and then layer 2 is like a special economic zone within which the projects and users are paying a lower tax to do the transactions. So it's not hard to see why layer 2 gets traction or gets network effect rather quick. But it doesn't argue that a particular layer 1 should have 50 or 100 of layer 2s built on top of which, because it will become very hard for those layer 2s to be able to build a sustainable ecosystem. Although, of course, people, or I think Eric mentioned earlier, a lot of layer 1 projects just make a copy paste onto a layer 2. There's obvious benefits to it. And one of the reasons maybe these layer 1 are from an alternative layer 1, which didn't really have a viable, large enough user base. Then they think, let's go to Ethereum layer 2 because it already has a very large user base, and there is a lot of developers familiar with the language and how to build it, and people can use same wallet to access this stuff. So I move there. But as more and more occurring, and without even thinking about the specific security or centralization aspect of the risk of some of these layer 2s, just purely out of the fact, how do you get enough projects to come into ecosystem? What type of grants you have to give to attract these new projects to come over? And is it really that simple where the developers don't have to do a lot of work because there's different level of compatibility when it comes to EVM compatibility. So and we have personal experience where I worked as co-founder for DeFi insurance protocol when we deploy on Arbitrum and then now considering on ZK. There are a lot of details to consider when projects determine whether or not to keep rolling out deployment on all of these layer 2s. And once, without a very strong capital backing, if you cannot compete initially, get a strong user base, then it's very hard to be sustainable. And then over time, some of the project will just disappear. Right? So it is very complex. It is very interesting that as an investor, we have a lot more choice and perspectives to look at. But at the same time, it brings actually the challenge of analyzing how can we judge on the sustainability of particular layer 1 versus the others.
Yeah, I think Julian brings up a good. Sorry, go.
Oh,
no, I think I was going to.
Sorry, go on. I think there's a delay.
Oh, sorry. I think Julian brings up a good point. The way we see things here at DLab is that ultimately, over the long term, the end consumer isn't really going to care what layer their app that they're using is deployed on. So the ones that are going to win are the ones that provide the best user experience, developer experience that allow developers to deploy apps seamlessly with very little friction. And then that allows end users to be bootstrapped directly onto the layer that the app is built on. And all that will be abstracted away. That's our view over the long term. So the way we see projects, Julian was talking about, making decisions about what layer to deploy on. I think the way we advise our projects and the way they should think about it is which layers, make it easy to bridge over. And you bootstrap, is there a wallet provider that bootstraps the user directly onto the layer instead of forcing users to bridge over, which could be quite complicated for certainly most normal users, but not the ones that are deep in the weeds. And the ecosystems that have robust set of use cases and applications for people to mess around with. And then for the projects, they're really good staging areas because sometimes, of course, there's large grant programs and maybe they can receive a grant, but also it's a really nice environment to try and find product market fit, test the product out and get early users and get feedback and try and iterate on that product. So.
Perfect. Thank you. Thanks so much for your insights, guys. I think we're ready to move on to the next topic. Eric, I'll pass over to you.
Yes, thank you. So from the previous conversation, it feels to me that after the layer 2 implementation, mass implementation, more and more layer 1 actually their other layer 1's opportunities were wiped out. And it's something that we, as an investor, and we are really need to think about what's the opportunities and what's the risk associated with other layer one solutions, and also the what's the new opportunities and risks on the layer two. So here, I'm curious, about our panelists. What's your takeaway on the risk associated with your layer two investment, both on the network side and also on the app side? So are there any different perspective from like investing on the layer one side? Are they similar, or they are very unique proposition on the layer two side?
Maybe as a start here, I think it makes sense to focus on the layer one, protocol side rather than the app side. I think the app side, it's largely similar risks on layer one as on layer two. The protocol side, is worth to note that a lot of this is still very experimental technology, especially on the CK side. The first mainnets are just being deployed. Yes, we've had months-long testnet, but still, like mainnet is a different beast. And it's also worth to note that actually a lot of these, like most optimistic rollups, they're not fully permissionless. So fraud proofs, for example, they're not live yet, they're not implemented yet. So I think the risk here is mostly on the tech side. In case there's any kind of hack, I think that's really the biggest risk. I mean, as we've seen with other layer ones in the past, one example here, for example, being Moonbeam with the Nomad hack. A big hack can have a huge impact on this ecosystem and really kind of drain a huge drain on user activity and liquidity. So I think here it's good to be diversified as an investor between the different layer two protocols, be it between optimistic and zero knowledge rollups, and then within these categories, different players as well. And just worth to note really that a lot of this is still very experimental. So there's inherent tech risk in all of that.
I would also say, like, course, novelty and defensibility are huge characteristics to look for, but of course, we also view things like go-to-market strategy, and can they bootstrap a community, creating economic incentives and create people building on their apps, people coming to their apps to use the app and create activity, almost just as importantly as the tech side of things, because people, just because you build it, people won't come. So we also focus on the go-to-market side, and I think that's super important. So
another important point. Okay, I'm sorry. Go ahead.
Go ahead. Sorry. Okay. So I would just want to add on a bit on the technology risk side. I think we all know the blockchain trilemma, right? Because layer two is resolving scalability, but at times security or decentralization might have become an issue because some of these layer twos are running single sequencer node locally to create and finalize the blocks. Hence they can create such a high TPS throughput because there isn't a need for verifying of those, let's say, with other nodes. But when the number of block producing nodes is small and the physical location is centralized, it's prone to those attacks to this single point of failures, as we probably have experienced a little bit with Arbitrum airdrop, where the demand has been so high, so it's crushed to the capability of that node. But whether these things can slowly be resolved or decentralized and hence improve the security is something to monitor. And the adoption risk, as we mentioned earlier, indeed is like how developer friendly it is, whether the tool sets that existing developer is able to use can just be brought over, or new things have to be, let's say, found out, sometimes bridge, sometimes just a graph and supporting tools. And then I think in general, but probably particularly for layer two, there might be more higher regulation risk if it is perceived to be more centralized. Those are my thoughts.
Jumping in on a few of those points as well. So generally, when we think about investing in the ecosystem of a specific L2, we think about the projects and investors taking on the risk of the L1 itself that the L2 is built on, as well as the underlying L2 platform if it's a dApp, and then also the dApp itself. So there's multiple layers of risk over there, not just on the security side, like others mentioned, but also just in the success of those platforms and the app. Additionally, taking on the risk of a competing dApp from another ecosystem moving onto the L2 platform, either directly from an L1 or another L2. This, of course, is in any direct competition that is already there on that L2 platform itself. So there's obviously a lot of competitive forces at play when developers are thinking about launching their dApps or their L2s. And it's important for founders and investors to evaluate the competition as they build and support their companies. Investors can be a little more proactive about encouraging their companies to be on multiple chains where applicable, so they can increase their market share across the entire crypto ecosystem and just generally gain more mind share amongst users. It's important to be where the users are. So they can partner up with different companies in various ecosystems to get a head start on solving their problems. Like, for example, cutting down integration times by using certain aspects of a specific L2 that doesn't require them to rebuild the same tooling or infrastructure. And, for example, one of our portfolio companies, Eclipse, is building a modular customizable L2 rollup that is connected to multiple L1s like Solana, Celestia, and a few others. Being connected to different L1s enables them to become a prominent L2 solution in the larger crypto ecosystem and helps alleviate some of the risk associated with being tied to just one L1. It also has the added benefit of gaining community members from multiple different L1 communities, which increases their own moat. So I think it's important to sort of, in today's world in crypto, to take a more multi-chain approach to things while also considering a lot of the factors like security risk and ecosystem and go-to-market like others have mentioned.
I think we have like a very broad, overview now in terms of, what type of risks we see as venture capitalists, like from the tech side to the, go-to-market strategy and the teams. Another very important piece that is also important is to understand, and I mean, we had the introduction at the beginning of the call about the macro and the outlook. This is the first time since this flourishing industry is confronted with monetary policy that is no longer expanding, right? We have something that is going to be very interesting in terms of the dynamics of how projects will sustain their future runway. And I think it's going to be an awakening for a lot of the VCs that are only used to this ever-growing cycle from when we started venturing into blockchain and crypto and all of its different applications. From the ICO craze all the way to the DeFi boom, NFTs, and where we are now today, to realize that we have, I'll call them the blue chips, right? That will, garner the mainstream attention from, the institutionals, and then you have everything else. And with everything else now facing this unprecedented, challenge of different market circumstances and different market environment, it's going to be pivotal for VCs to adapt to that as well as part of their strategy when investing. And I think that is a very, very important point to highlight when looking at investing in these kind of solutions.
Thank you.
I think it's also worth pointing out that there's still a ton of risks that we haven't really the ecosystem hasn't solved yet, particularly in the EVM space, particularly as it relates to bridging. So trustless bridging hasn't completely been solved yet, and then also the issue around canonical assets. So as this has resulted currently in USD various versions of like USDC, let's say, on different versions, different L2s that aren't exactly one for one because they've been bridged over through different service providers. So I think it's important to note that there's still a long way to go and to create that seamless user experience and some key risks associated there.
Makes sense. So yeah, Paul, would you like to go ahead with the last question, given that we are limited of time right now?
Yeah, so it's been a great discussion in talking about the concepts, the business models, the risk that is there with L2 networks. But if we could go into maybe more practical the discussion. So how do you guys value those L2s and projects on those L2s? Is it somewhat different to how you do it with L1s? Because what I often hear from retail investors, they ask, so there's so much stuff going on with Arbitrum and Optimum and Optimus, sorry. So does it mean Ethereum's price is going to go down because the use cases are going to move from Ethereum to layer 2? So L2 tokens will rise in price and then the Ethereum price will go down. Is that really the case? So there seems to be a naive and questions on the surface. So it would be good to know how you're looking at the valuations of those networks. So how do you what's the decision-making process for buying or not buying a particular token, or investing or not investing in a particular L2 dApp, basing on the nature of those dApps. So what are the metrics? What are the nitty-gritty stuff you're looking at to come up with some numbers?
Happy to give it a try. I don't think Ethereum price should go down. If anything, it should go up based on the success of more layer 2s, because ultimately it is allowing more dApps and more use cases to be developed, and all of the transactions that pass through Ethereum still have to pay a gas fee. So in terms of valuing the layer 2, so for one is the potential market size, indeed, whether it has a particular use case in mind, how much likely it's able to grab from the other layer 2 or other layer 1, indeed, or creating basically new demand. And then within that process, of course, there's a hard metric that can be looked at. Otherwise, it's very, very early in the idea state. As long as the later state, they would have testnet, they would have, let's say, data in terms of how many projects are active, how many users are trying the chain. And then finally, looking at the tokenomics, where the design, whether there's a supply cap for the token, how token holders are accruing value, do they have rights or entitled to have share the fee incomes, what other utility it may give except governance, and if it is about governance, what kind of governance rights actually assigned to the token holders. And these are, let's say, in addition to, of course, the team and their capability of executing those ideas are more the soft standard. But all of this together is piled up, and then we can look at those against existing layer 2 that are already listed, and how do they pan out in terms of valuation, get sort of a reference point to consider.
Yeah, maybe I can chip in here. I definitely agree with Gillian. As more layer 2s spin up and more apps built on layer 2s, I'm sure Ethereum the price wouldn't go down for Ethereum. So it's definitely beneficial for the whole Ethereum ecosystem. Thing that's not built built on top of Ethereum or anything that's EVM, it will still event benefit and try to draw out all this fragmented liquidity onto a more, connected ecosystem, right? So what I always look at is a lot of this kind of typical metrics that I do when I evaluate the apps that's on layer 1, TVL, DAU, MAUs, and even on the comp set that you do when you do competitive analysis, I don't draw out specific layer 2 comparisons that's on there. I also do look at layer 1. So for example, if I'm looking at an AMM DEX, I look at AMM DEX on Ethereum itself. I can do comps on, Uniswap, Curve, PancakeSwap and stuff. If I'm comparing an AMM DEX, I don't particularly just carve it out and compare it amongst the layer 2s. Of course, for example, if I compare it to Velodrome and Camelot, there's a more of a comparable comparison, because the TVL on these layer 2s are comparable as opposed to anyone that's on the base layer. But typically the metrics are still the same, maybe just different kinds of risks, which is what we have mentioned before. That will be my main considerations with regards to valuations.
And I think also from just grounding this an example in the real world, when we're looking at TSMC, right, a semiconductor producer, $13 trillion market cap. This would be your Ethereum layer 1, right? And then you have all of the layer 2s, for example, Tesla, that would use products that are produced from within TSMC within Tesla. And so Tesla has a market cap of roughly 600 billion right now. So you can see that there is a connection on that side, and they're symbiotic on that end, right? But at the end of the day, the one providing the fundamental technology, right, is the one that is driving the innovation in that sense, and really provides that sort of base layer for the other companies to thrive on their own. And I personally see it the same way in the crypto and blockchain space. Now, when we're looking at how to evaluate, certain projects and investments, it comes down to the same metrics that you would have for any other business, right? The entire composition of that company is within its own metrics, right? As important as the foundational layer, be it level 1 or level 2.
I think Julien brings up a a good point that it's still, very, very early, which is indicative of the size of the opportunity in front of us. So, if the ecosystem, if the communities and the ecosystems do a really good job creating use cases, bringing people on chain to use the apps, it's a rising tide rises all ships. So, it's logical to follow that, the market values of a lot of these layers will increase over time.
And to add to that, once you have confirmation on the layer twos, you just have confirmation on the layer two. If it's a high value transaction, you definitely want that to be rolled up to the layer one. And as a result of that, even though you might have more layer twos, a lot of those transactions would be important for them to sort of get confirmed on the layer one. And as a result of that, competition for Ethereum block space is going to keep increasing. And as a result of that, I think that's kind of one of the reasons why we are going to keep seeing the value of Ethereum, the demand for Ethereum go up, even though we see a lot of these layer twos come into play. And even with that, I think we're definitely going to see a lot of new models come up over the next few years of how people are trying to sort of further reduce the cost. If you have $100,000 node layer two network, do you really need to go to Ethereum to confirm that? That's kind of debatable on how the concept of security evolves, whether people think that a very large layer two is secure enough and we don't need to roll that up to layer one. We haven't seen any models like that yet where people don't feel the need to roll it up to a layer one, but we might see that in the future as maybe the cost of Ethereum goes up quite significantly. In terms of what we look at for evaluating projects, typically more on the venture side, we definitely have a very, very strong focus on the founding team because we're a seed stage investor. We also look at what the uniqueness of the core technology innovation is. Do they have a differentiated go-to-market strategy? What is their current traction, usage, partnerships? Like I mentioned previously, the competitive landscape, that's something that's super important for us. So we have a very thorough due diligence process. We do a very in-depth code review as well to make sure that there aren't a lot of security risks. And obviously we expect companies to have the right security audits before an investment is made. So I think tools just like L1s tend to garner a higher valuation compared to dApps or infrastructure projects because they're decentralized platforms upon which dApps are built. But dApps can also go multi-chain and de-risk themselves from the underlying platform. Although that isn't typically something you see at the early stages of a company, that is the potential for it to happen for a dApp. So, I think that there's no reason why a specific dApp cannot be valued higher than a specific L1 or L2.
All right, okay. Thanks very much, guys, for your inputs. These are really valuable insights. So I think we're wrapping up, right? So unless you guys want to talk more about the metrics. So it was a very good discussion. And Alicia, do you want to add some closing remarks then?
Yeah, so I would like to say a huge thank you to all of you guys, all the speakers and all the panelists for sharing their expertise and insights. And of course, I would like to thank all the listeners to our speakers. We hope that this webinar have been fun and informative for all of you guys. And have a fantastic day, and we can wait to see you at next our event. So feel free to reach out to all of us in private if you want to discuss something else in particular. And thanks for watching, guys.
Thank you.
Thank you.
Thank you.
Bye.
Thank you, everyone.